execution. It's often overlooked by traders, not through any fault of their own. It's never really focused upon. And the reason that I really push on execution, when to trade, when not to trade, is it can really save your ass. We'll get into the emotional side of things next week. One of the calls, that the other 3 calls will be next week. If you having a rough patch, it affects your emotions, and you generally deviate from the plan. And the worse your trading becomes, the worse your emotions become, and it's a vicious circle. So execution needs to be spot on for your own mental health, basically. Because I think a lot of people can vouch that trading can really take you to some dark places, like it did with me. Well, it still does sometimes. A lot of traders who are new, they'll study a course, or they'll copy it, they'll learn a strategy, they'll join some sort of community, and all that is basically imposed on them is technical analysis. And when price hits your technical analysis, where you want to buy or sell, you buy or sell, and then you have whatever targeting system you have, and then you just go out and execute. Now, if trading was that easy, everybody who ever did a trading course would profit from it. But there isn't, so there's got to be something else. There's got to be something that all of these new traders coming into the market are not doing or not being taught. And my reasoning for it is because everybody out there on social media who's pushing courses and signals, they've got an agenda which is not your quality of trading. Their agenda is to just make as much money as they can from subscriptions. So their whole business model is based around making money off subscribers. It's not quality of trading. Now, especially the signals providers and the education companies that you have to sign up for a particular broker through their link, their recommended broker, that's a massive red flag, because they're paid by the broker. So the more commission that you give to that company, so the more trades that you take, the more money that service provider makes through the broker indirectly from the trader. And some brokers even pay that person who's referred you a portion of your losses, because you get B-bucked straight away. As soon as you create the account, you go into a B-buck. Your trades will not go through to the market. If you have a series of winning trades and you come to withdraw money, you'll be paid from the pool of cash from everybody else in the B-buck. So they know they've been doing it for years. They know who's going to make. They know their risk, so they know who is likely to lose money. When you start making money consistently, they'll move you onto the A-buck, and they'll obviously offset their risk, because you're a risk to them, like a bookmaker website. As soon as you start making money consistently, they just ban you. That won't necessarily happen in through a broker. It wouldn't surprise me if it starts happening a lot through funded accounts. I see that happening, people getting denied payouts. They make a lot of these companies, FTMO, are pretty straight down the line. A lot of these other companies put every sort of rule in place to be able to deny payouts, so they are going the same way as a bookmaker. Because a bookmaker has their own market that they create. A online prop firm also has its own market that they create, because it's a demo trading account. So, with all this information that you've got now, it shows how easy it is for their business model to skim money through your subscription, through your trades, through your losses. So all they need to do is make you take trades consistently. Whether they win or lose, it doesn't matter. And if you've got 200 people in a channel and 3 of them get a win each day, 3 or 4, and go out on social media and share that win, and then the next day 2 people get a win, you see how every day there's somebody sharing wins to make this service look brilliant, because nobody shares the losses. They just leave, but then you get replaced by somebody else. So it's a never-ending cycle for these gurus, let's call them. So that's essentially their business model. Now, if they start, well, my other opinion is that they don't know about execution and risk-driven markets, because they're likely they've only known about forex trading for a while, and they've managed to create some online persona and then create their own service. So they are still basically hanging off the teat of their mum, because trading wise, because they literally don't know anything. They know enough to create a persona that they can create a reliance upon in their community. That's another thing these gurus can do, is create a reliance. They won't give you the skills. Again, I don't think they know the skills anyway, but they don't want to do that because they'll lose you to the markets, because you can go out into the market on your own, and then they've basically lost a revenue stream. So, in my opinion, these courses have to be. They can't seem too simple, because people will think, "Oh, that's rubbish. I'm not interested in that." They can't be as complicated as they need to be, because the new trader will then think, "Fuck, I haven't got the fucking patience, the time, the knowledge, the brains, the commitment to learn all this, so I'm not going to bother." So they just pitch it right in the middle, somewhere that it just seems like the education material is quality enough, slightly not difficult to understand, but slightly technical, to make it seem like it's a good value for money. But then it has to be easy enough that anybody can just follow it. So this is the whole business model. Now, as soon as they start doing what I do, and they say, "Well, what about this? What about this? If the market's moving here, you shouldn't be taking a trade here." It just adds layer and layer of complexity on top of it. So I personally find a lot of people just give up and leave, and then they go and look for an easier way. And eventually they'll find that there isn't an easier way, because all successful traders know about risk-driven markets, and when to execute, when not to execute, when to preserve your capital, when to ramp up the risk a little bit. People say, "Oh, you should always take the same size trade." It doesn't matter what people say. All that matters is, are you comfortable enough to always execute your plan? Now, if you just start ramping up your risk, it's likely that you're going to be uncomfortable with executing your plan, because if you increase your risk and you get to a point where you should be closing the trade, but you're looking at the losses and thinking, "That's too much for me to lose, I'm not losing that," and then you just spiral out of control. So it doesn't matter what anybody says, doesn't matter what I say. I just want to give you the building blocks and the tools to find your own way, to make your own decisions, to fuck around and find out. So there was a trade today. Getting on to execution now. Just a quick example. There was a trade today, pound New Zealand dollar, and I didn't want to take it when price was really close to the level. And my reasoning behind it was I felt like there was going to be a bigger move. I felt like the market was just winding up to do something. And I started to think, what about what's a pound New Zealand dollar doing? So that was pushing higher, but it wasn't causing all New Zealand dollar pairs to move. Euro New Zealand dollar was just moving sideways all day, but even that was at a level there. So even though NZD USD was moving higher slightly, it was still at roundabout level here. And GN is probably my most traded pair after cable. So eventually I just thought I have to give myself a bit of a slap, and this happens all the time with me. I start thinking about things, but then I just give myself a slap, look across the market and think, remember that I don't trade what I think. Now, if New Zealand dollar, US dollar was continuing to drive and Euro New Zealand dollar was moving lower, pound New Zealand dollar was moving lower, that would have been fair reason for me to back off and say I'm not going to take that. Or at least reduce my risk, depending on what level, what part of the journey the trader's in. I would say if you still want to take it, reduce the risk, find out, get the data. So I even messaged Jay and said I don't really want to take it, and it's something I do all the time. And then I say a minute later I've taken it because I have to, because it fits in with my plan. Whether I like the look of it or not is completely irrelevant. And I see it quite a lot in the channel that traders didn't like the look of that particular level or that particular refinement. If it fits in with your plan, you have to just execute it. Because what I don't like to see at the end of a week is that a trader has got their eye on a particular setup all week, and then it comes to the end of the week and they haven't taken it, but they've taken other things that were not in their plan. Even if that trade wasn't taken, I'd want to see valid reasoning behind the cancelled order. It's better to just take it, because if you've been looking at that all week and it fits your criteria, don't veer into the lane of trading what you think. Even if your strategy is not a levels based strategy, it's a trend line or EMA or Bollinger Bands or whatever. If you like the setup and it fits in the criteria of your edge, you have to just take it. And it's another thing, strong moves into levels as well. If you get a strong, fast move into a level, it doesn't mean that your level isn't going to work. You know, we see strong moves all the time into levels. And if you sometimes say we've got a level here, and you look at the 4-hour candle and it's gone straight through off the back of some data, I can guarantee that if you were watching this at the time the market went, and it would have pulled back in that at that level. Don't be afraid because the market's making an impulsive move and it's flying towards your level. The worst moves for me are drifts, when the market's drifting into a level. That's when I'm thinking, fuck this, I don't want to take it, because try and find just a slow drifting move into a level. Like I think pound CAD does it quite often. No, but you know what I mean. I'll try and find one when I edit the video. But this sort of thing, when the market just drifts and drifts and drifts, I prefer a spike up into my level any day of the week. But these drifts of death that just can go on and on and on, that's what's more likely to kill you, because the move in its nature is just slow, and it's a balanced move because it's moving cyclically towards your level, towards your setup. So there's a balanced market. There's profit taking as the price is moving because it's going up and down, up and down. So that is a healthy, balanced market. It can just go and go and go. What I want to see is an unbalanced market where something needs to give, even if it just needs to give for a minute while it pulls back and it allows me to get in and get out. So never be afraid of any setups or any moves into your setups. And then a good thing to improve your execution is to create a separate spreadsheet, just like a bad habit finder. We'll do a quick example now. I stop sharing the screen and just share the entire screen instead. We go on to this spreadsheet. So if you've got a problem, cancelling orders, jumping into trades that you hadn't planned to, and then just list some numbers down the side. 3, 4, 5, and then whenever you do one of these actions, just stick an X in the box and move on. And then you've got whatever issues that you're having with your execution, whether you're afraid to take the trade. So basically, if you have a trade at the end of the week that it was a setup that you were looking to take and you didn't take it, put the reason why and put it in that spreadsheet. If it was because you were afraid to take the risk because it was a strong move, put that in. Put strong move, fear. If it was because you already had too many trades open and you didn't want to take the extra risk, then put that in there. All these different reasons why you didn't take the trade, and then it's a really simple but effective way of doing it. You'll find out what your problems are, but then the first thing you need to do is find out, why do you have the problem? Why do you keep cancelling orders? Why do you keep jumping into trades? Because there's going to be an underlying issue which causes you to repeat these errors time and time again. And it's one of my biggest problem through my whole trading career was letting go of losses. It was something that I really struggled with, and I thought I could always get out of a trade it just really isn't worth it. And my reasoning, I think, was a little bit of greed, because you'd be doing really well. You know, your account would be massively up, and I didn't want to make a dent into that account. It seems pathetic, really, because when I look at it now, I don't care about dumping a trade that no longer fits my plan. It's just a going cost, an overhead. Just dump it and then move on to the next one, because I think a lot of traders as well, they just they suffer with recency bias. They're too stuck in the now. There's going to be another opportunity in a few hours or a day. So you don't have to overtrade or hang on or fight a level. Like, again, these strong moves, we're seeing, what was it, pound New Zealand dollar early in the week, wasn't it? Can't remember. It was a revisit of the daily on, I can't remember what it was. I've got so much going on in my mind. There's a strong move happening in the market. You don't see the setup. You don't have your driver coming to a level. So, for example, if you don't know the strategy, someone said it was Cable Monday. Yeah, it was, yeah. Because I took it Sunday evening before I went to bed, when first retest, and Monday as well. So here, for example, this move happened because Powell spoke at Jackson Hole. Basically said that they're likely to see lower interest rates in the US. So we had a move against the dollar. Stock market moved higher. Didn't quite get to a level of interest. So there was no trade, but I'm not going to worry about that. I'm not going to try and jump on something because it doesn't meet my edge. My edge is that in this scenario, I have to have the driver, which was the US stock market, US 500. I have to have that hitting a level before I can enter a pound US dollar sell. If I don't have that, I'm not going to trade. Now, I'm not going to panic and think, I'm going to miss the move, I'm going to miss the pullback. Have the confidence or the awareness that the market is going to come back. It's going to give you another opportunity to enter. The market hardly ever makes a really strong move and then just falls. There's too much at play. There's too many forces at play for that to happen. So the market needs to pick up liquidity before it can go on its journey and pull further down to retrace this move. Now, if the market opened on Sunday and we're still driving higher, then the game's back on. We're waiting for stocks to hit a level. Generally doesn't happen though. The candle close retest is something that you can get into your trade that you were panicking about on Friday or the previous day. Just be relaxed and understand that the opportunity to get in the move that you want to get into will come, and it'll be in a much easier and friendlier guise because there won't be flows. Generally what I like to see is a bit of a strong move higher without any news. I just see the currency pair making a move, and it almost doesn't make sense. When I see that, I think brilliant. This is my opportunity to now get back into the market. So when it comes to my level, I'll execute. So whereas in the past I could have been trying to trade this level, trade this level, trade this level, and getting my ass handed to me. What you need to understand is that to get your execution, to get the correct execution, you have to find out, why is the market moving like this? If you're seeing this across all dollar pairs, which we did, the execution at the time of the move does not lie in the technical analysis of the currency pair. The execution lies on whatever is causing the move. So when US 500 was steaming higher, it didn't quite get to my level of interest on Friday, so there was no trade for me. I can just sit and wait at peace as well, because I know it's highly likely that I'm going to get the chance to get into that trade the next trading session. So even when it does pull back and it does, 26, and if it was an antipod or minor pair, that was probably going to be a 50, 75 pip move. And watching that pullback happen when you're not in, I understand it. It can be frustrating because you've planned to take this trade and you haven't got in. But be confident and comfortable with the fact that it's going to give you it's highly likely to give you an opportunity to get in the following trading session. And do you know what? If it doesn't matter, because you followed your plan and you've preserved your capital, which is the number one goal of trading before anything else, is capital preservation. So your job as a trader is to allocate risk to patterns that you see in the market, repeatable patterns. So your approach when a repeatable pattern is the stock market is moving higher, causing all the other currency pairs to move, and when the stock market hits a level, currency pairs will pull back. That is a repeatable pattern. Now it isn't as simple as that, of course, because you'll see, a lot of traders might have been looking at this level, or depending on what strategy you trade, traders might have had a 61 fib and that level, and then having absolutely no idea why that's just been blasted through, because we only take the most significant levels on the chart nearby when we are looking for a flow scenario, a risk-driven move to stop. Now, it did hit the daily, but for me it was just too much of a distance. The gap was too wide, so I was happy to go for the extremity. It nearly got there, but doesn't matter because the opportunity came in the following trading session. So that was a bit of a couple of drawn out examples of execution. Like the pound New Zealand dollar trade this morning was completely different because there was nothing else really driving the market. We've got to our level here. Look at the 15-minute. And I was aiming for this target area. So if you put a box in there and then go down through the time frames, $15-minute. So obviously it did a little bit of drawdown, 12 pips, 11, 12 pips, and it's done the 32 pips to the area of potential struggle. But I was more concerned about taking that pound New Zealand dollar trade this morning than I was about the cable sell, which is where I think traders need to be. Now, traders will go into 4-hour levels and intraday levels willy-nilly and take every single one like a scattergun approach. for me, the quality trades are the risk-driven scenario ones, because you're trading from a script, and some of the best trades that you'll ever have are when we look at our triggers for execution. We look across the market, and I always use the shopping basket analogy, where you looking across the market, and you've got stock market coming to a level, you've got your USD, cable, you've got some minor pairs coming to a level, you've got yields at a level, and if you're writing it down or you're going through it in your head, and it just makes so much sense that it's too easy, and you take the trade, and it honestly feels like, I think that's when you feel like you really turn a corner with trading, because it just becomes simple. So I love risk-driven markets, and there's that. I always say you got to be patient, and patience pays. But there's two levels to patience. Now, if the market's been moving sideways, like this week's been pretty subdued. There's been some opportunities, but look, Monday we just moved sideways on pound New Zealand dollar, and then if you look at previous weeks, it's been going, trending higher. There's a lot of markets this week which are just in a tight range. Euro New Zealand. So I say to people, you've got to be patient. So people are patient until a move starts happening, and then they think to themselves, "I've been patient. Now it's ready to go. I'm ready for action." This is when the second stage patience comes in. So there's two levels of patience that you need. You don't wait. You can wait and wait and wait, but then when the market starts moving, that isn't a signal to play, because the market has been winding up. Here, it's been winding up like a coiled spring, getting tighter and tighter, and it's going to go. And I don't know where it's going to go. I don't know which way it's going to go. It's either going to go up or down, obviously. Or if it was pound CAD, it might just carry on going sideways for another fucking 6 months. We've had some pound CAD consolidations go on for fucking weeks, and even edited the range shop to say pound CAD at one point because I was so annoyed. The market is just winding up and winding up, and it's going to make a move. It's going to break out. So we're not executing and fighting against the move when the move starts. There could be a myriad of reasons for the market breaking out. It could be risk driven. It's more likely that the market is just a waiting direction, and it's waiting for some news for the buyers to outnumber the sellers, or the opposite way around. So when that move happens, we quickly need to establish why. Why is the market moving? Is it a Euro-based move? Is it a New Zealand-based move? Is it a whole market move? They're your three options. And then once we've worked out what's causing the move, then we can understand how we're going to approach the next trade. So if it's New Zealand dollar, US dollar moving higher, we're going to see potentially Euro New Zealand dollar move lower. And if we come down to this level and New Zealand dollar, US dollar is hitting a level, then we're good to go. But if we're waiting and waiting, if this is coming down and down, and Euro New Zealand dollar, US dollar is going higher, and now it hits a level, that's our execution. So this is the level we want to trade from, but our execution is here because it's dictated by the driver. Now that could be stocks, it could be New Zealand dollar, US dollar, it could be Euro USD. In all honesty, it could be fucking, I don't know, coffee. It's a stupid example, but if you know where to look across the markets, you don't need to understand why the move's happening. You just need to understand that, oh, this market is moving in a volatile fashion. It's making a move, and it's causing this currency pair that I want to trade, it's causing that to move. So as soon as you see like a red candle with no wick on it, and it's pushing down, and you see another market which has got a green candle going up, and it's causing, and you see it moving, and it's causing the exact replication on this, then that's your driver. It obviously, as a stupid example, coffee, but it's, you know what I mean? Sometimes it can be CAD and it can be oil. Sometimes the US stock market can go higher, where generally we would associate that with dollar weakness, but the stock market can go higher and we can see dollar strength. So don't get too hung up on the directions. Is it risk on? Is it risk off? Understand what a risk-on environment is and a risk-off environment. A risk-on environment is when there's been some good economical data and people are thinking, right, it's the world economy is safe enough right now for me to have a gamble. So the US stock market will go higher and antipods will go stronger because they are seen as a bit of a gamble, a risk currency. Now, if there's something shit happening in the world, we're risk off. We don't want to take the risk. So we'll pull all of our money out of the stock market and pile it into the dollar because that's the safe place. It used to be yen, not so much anymore, but it still does have a place as a safe haven. But if the market is driving, we're going to take away our money from these risk assets. Antipods, CAD is considered an antipod as well. So Aussie and New Zealand mainly, Canadian dollar. We're going to take our money away from those and we're going to pile into the US dollar. So what are we going to see? We're going to see US dollar, New Zealand dollar, US dollar drop. We're going to see cable drop. We're going to see Euro USD drop. We're going to see dollar yen go higher. We're going to see stocks dropping. So we leave all those currency pairs until the stock market hits a level and then we take our pick. Because if it's a risk-driven environment, almost every single currency pair making a move will pull back at the same time as stocks. So you could literally take your pick what you trade. And I will find an example for the edit. I'm not going to waste your time looking through the charts now, but I'll find an example of a time where the whole market turned. And it's literally taking candy from a baby. But going back to why I started ranting there, Euro New Zealand dollar is now winding up and winding up and winding up. And if that move starts and people think, well, I've been patient now since Monday, so you can be fucked if you think I'm not getting involved in this move. So then traders think that they're gonna be rewarded for their patience now. It's simply not the case. Second stage patience, the more difficult patience, now needs to come into play. But you're ready. You're at the screen. All it does for me is I'll set alerts either side of Euro New Zealand dollar, and as soon as the alerts go off, I'm ready now. Whatever I was doing in the office or wherever I was, that gets put to one side and I'm on the screen, war face. And all I'm going to do is sit and watch, because that's what we do as traders. We sit, we identify opportunities, we sit, wait and watch, and then we execute. But that execution has got to be in line with our edge. If some traders aren't interested in trading like this. They'll literally just take everything and hope that their risk reward and their psychological state all stay intact long enough for them to keep consistently taking money from the market. In my opinion, only 10% of traders can do that. That's why 90% fail. It's a tough skill set to master. But I always say to these traders, why don't you just learn a little bit about concession? What's the word? So I say to traders, why don't you look at the discretionary side? And they think, oh, it's too complicated. It really isn't. If you got an alert before your order, and the market's steaming into your area, and you've got your alert, have a quick scan across the market. If there's something tanking or going higher that's causing your move, bin that order, because that's going to eradicate. It's going to skim off the losses, a lot of losses, and that's going to do amazing things for your bottom line and your psychology. And it isn't really, it's overcomplicated by a lot of traders, and I see people in the channel overcomplicate it as well. I generally need people to get away from saying I did this because I thought. If you've got a daily level, so I'm going to pick on Damo because he's my neighbour. If you've got a daily level, like we had earlier in the week here, sorry, this is the daily level. Sorry, wrong area. So this is the daily level. If you've got a daily level and there's a decent move into it, past ATR, you're starting to tick boxes now, right? We're past ATR. We've had a strong move with no pullback into a daily level. Do I want to take the refinement? I only want to take the refinement on a minor currency pair. We covered this last week, that the EURNZD is the driver. So I'm going to stick my level on the daily, and I'm going to go for it, which essentially I could have done that on stocks last week, actually, and got my pound dollar sell. But I was confident. I knew that it'd get a 4-hour retest the following trading session. So I wasn't asked about getting into the move, because I just see it. This is what I mean about knowing your pairs. Like, I know what I'm looking for on cable all the time. It happens. So I wasn't really asked about cable. This sort of thing you can't put in a course, can you? It's literally, you just see it over time. You see it over hundreds and hundreds of different times, and you don't know anything about it, and then all of a sudden you think, fucking hell, why don't I start taking advantage of this? But anyway, picking on Damo again. So Damo refined to the 4-hour level after the daily worked twice this week. So it went 50 pips twice. And then it's come in and it's just gone below the level. I would expect the level to draw down slightly if the start of the levels worked. Another thing that I do from experience, stick an order just past the level. The amount of times that EURNZD and cable just pop a few pips past a strong level and then pull back is wild. But you need to see that happening time and time and time again. So ticking the boxes for your execution. There was a daily level. There was EURNZD was the driver. We were past ATR. It was a strong move. There was no pullback. We need profit taking. In my opinion, we need profit taking in the first chance that we get. I don't mind covering this zone of 20, 30 pips. I can almost guarantee that if that did probe further into the level, it wouldn't have done any drawdown. But we're just talking about, what ifs here. The market did no drawdown on the daily level, and then it made a move twice. So when you're ticking your boxes, you're building up a case for the buy, and you're thinking, well, I've got so much here now that if I don't take it, there's a high probability that I'm going to miss out. And the trade-off is that you might have a little bit of drawdown if it does go to your level, to the refinement that you've got. Now, a lot of traders, say get into the market at the point closest to where you're wrong, where you feel like you're going to be wrong. That is, I would say that is good advice for traders that have a lot of losses, that have a lot of drawdown in their opportunities. If you are trading retests, again, that is another good way to approach the market. Because we don't trade break retests, well, I don't personally, it's less of a problem, because I'm waiting for the market to breach these retest levels, and then I want to pick up, start interacting with the first good buy level instead of these sell levels. So I don't want to get into the market where I'm as close as I can be to being wrong, even though if this level worked and Damo got into the market as close to as possible to where he was wrong, his entry would have been immaculate. It does also help that this was the next intraday level down. So the execution there from a daily level, it was a no-brainer, because you're looking across the market at what's happening, looking at the price action, overextended, past ATR, first place to potentially take profit. Try it. What I encourage people to do is try these opportunities, don't overthink them, and the learning is all in the journal, in the review. If you have a trade laid out like that, and you've listed all these different reasons for taking the trade, even if it loses, it doesn't matter. It's just a cost of trading. It's an overhead. We never have a 100% record. Nobody has a 100% record. Only Instagram traders. Sometimes trades are going to lose, but if you have got a strong move, you can do a lot to put that probability into your hands by adapting your execution according to the market. So what we need to get away from is not taking trades because you think that they're not going to work. If you've done the work, you put the work in, you've got to take the trade to find out whether your strategy, your edge, whether you've got an edge in the market. And remember, your edge, part of your edge should be the reason that the market is getting to your trade, to your order. Pan New Zealand example. And if you're not journaling, by the way, I know most people in this community do, but if you just stumble across this video on YouTube and you don't journal and you are not making progress in the markets, you never will. Feel free to drop me a message on any of the channels and I'll help you with some guidelines for journaling. I'm not doing this to try and massage my ego. I'm doing it because I really enjoy talking about the financial markets. I said this call would be 20 minutes and I've been talking for 50 minutes now and nobody's even encouraged me. So it does make me think that I'm a fucking lunatic sometimes, but I'm passionate about the markets. I do it because I enjoy it. I enjoy pitting myself against the market, and when everything works and honestly, trading got enjoyable for me when I started to consider and take actions around sentiment moves, risk-driven moves. Once I understood that, and I'm happy to just sit on my hands, that's when trading actually just becomes a pleasure, because it's, you know, when you need to take a loss, it takes all that uncertainty away, because you if you can understand why your trades lose, there's no reason to be frustrated or upset or deviate from your plan. It's just such an underrated skill in trading, is understanding why trades lose. And this is a problem with, like, if you're in a signal service, you're never going to learn, because they'll just say trade lost, move on. There's no top-down review of why that trade didn't work, and a lot of the time, like I said a minute ago, trades can just fail. Like, levels can break. If I'm sitting all day in a risk-driven market and I'm waiting for US 500 to hit a level, there's a chance that that level can breach. Now, this is for another day, but it helps if you understand why the market is moving. So this is another level to risk-driven markets. If you can understand why the stock market is moving. Now, if the stock market is moving because there's a fucking Wall Street crash, I am not going to take this 4-hour level. Or this 4-hour level. If we're getting circuit breakers down on the market, so basically if the market goes a certain distance, they pull the plug in Wall Street. They stop trading for the day. And not for the day, they'll take a break for a specific amount of time. And then everything gets going again. And if the market hits circuit breaker down again, they'll pull the plug again. And if it goes a certain percentage, they pull the market for the whole day. So there's these protections in place. So this is another extreme example, but understanding why the market is doing something, it sort of gives me an idea of, shall I take this trade? If it's just a bit of data, if it's 100,000 less jobs on NFP, 100,000 less than consensus, I ain't going to fucking dive out of the way of this level. Not a fucking chance, because all it is NFP. It gives you a good gauge on what, why the market is moving, how strong it's moving. If we were 400,000 away, then I might think, fucking hell, that's massive. We've had a few massive ones in the past, and the market's gone fucking haywire. Take a step back, because you've always got that opportunity on cable where once the move has stopped, you're going to pick it up and get in anyway in the next trading session. So if you can be comfortable in understanding that the next opportunity is just going to be around the corner, potentially even off on that same move, you don't have to go chasing anything or fighting any moves ever. But understanding risk and aligning your execution with that. So in a subdued market, execute to your heart's content, because that is how you find out your edge in the market. Remember, if you are executing from intraday levels, and in your review you've got like 4 intraday failed levels on cable, all buys, and you realise that the market is trending downwards, that should tell you a story. It should be obvious, but I'm going to tell you anyway. The market's fucking trending down, and you're trying to buy the lows in a downward trend, which goes like this, taking out the lows. So why do we want to fucking buy all these intraday levels on the way down? We don't. So when you're doing your review in your journal, note what the type of market phase we're in that currency pair. Are we sideways? Flat market? Are we consolidating sideways? Are we moving down? Are we moving up? Is it a risk-driven move? It's just the four, really. Sideways, up, down, risk-driven. It's, if you consider that, like I've seen traders fucking smash it for weeks, and they think that they made it in life. They think, this is it now. I've passed an FTMO. I've got a payout. And they've literally just been trading in a sideways market, intraday levels, smashing it. And then all of a sudden, that one market, that currency pair that they've been trading, starts moving higher or lower. And then they've no longer made it in life because what they've been doing isn't working anymore. And that's what people say about sometimes your strategy will work, sometimes it won't. It'll always work. It just, you've got to wait for your edge in the market to execute your strategy. But you've got to take the trades and you've got to find out to understand what your edge is. And that's what we try to do with the performance coaching. And honestly, it pisses me off because as soon as people start the coaching, their trading improves fucking massively. Because they're journaling, they're thinking about everything, they're not jumping into shit because they don't want to embarrass themselves when I do a review for them and call them a cunt. Excuse the language. So it pisses me off because I want somebody to have had a terrible, terrible week so I can pick apart all these trades. Why did you jump into this? Why did you take this when flows are happening? I just don't get it. And that shows that to make a massive improvement, journal and hold yourself accountable. And just those steps will take you to the next level. And then if you can add this skill around execution, the world's your oyster. Add your patience to that and you should be flying. And I think I've covered everything I wanted to cover there in 20 minutes. Well, a little bit over. 58. So, if anybody's got any questions, fire away. Hopefully, we've talked about some good stuff there, some insightful stuff that you can take away and put into your trading. Next call is going to be about risk management. Again, there's going to be some ideas which you think they might sound foreign, they might sound crazy if you're a new trader. If you're watching this on YouTube and you've never had the pleasure of listening to me talk shit for hours before, these might be alien concepts to you, but everything's designed to keep you in the game. Capital preservation is number one. You might think that the best trader can pass an FTMO in one trade. That is what you call a bullshitter. Because if you can pass an FTMO in one trade, you can fail an FTMO in one trade. But they're never going to show you that, are they? So we'll get into risk management. We'll have a quick discussion on how I would approach and how I have approached funded account challenges. How you can sustain your funded account once you've got it for longer. By implementing your own rules rather than the rules that are forced upon you by these companies, which want you to blow the account, by the way. Remember what we said earlier about business models. The best way to be a trader is to have your own capital in a licensed broker, a reputable broker with good spreads and no shitty tricks. Because if you're using a funded account, a prop firm, anything else, you have got odds stacked against you on the challenges and with the accounts. They want you to blow money. A decent, reputable broker doesn't give a shit if you make money or not, because they'll make money off you. Like, if you become a really good trader, they'll take the same side as you, potentially. Which is what you'd like to think these prop firms do. But whether they do or not, I guess some probably do. I know Alpha have spoken to them in the past, and it was something that they were planning on doing. But anyway, that's all for the call, which will probably be on Monday. So, hope you've enjoyed it. Drop us a like or a comment, or like I said, get in touch with me if you want any advice on journaling or anything else trading related. Just drop us a message on one of the links in the description. Cheers, guys.